Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I am Prashant. Well, I'm not in the studios, as you can see. I'm coming to you from the sidelines of the Morgan Stanley Annual India Investment Forum. It's a marquee event as far as investments go here in India. And I'm coming to you from the sidelines of it. We're sitting down with a very special guest who I'll introduce in just a bit from now. But first up, Nigel Surabhi, good morning.
Hi, Prashant. Good morning. And we're really looking forward to the insights that you're going to pick up from that conference today. And it's really important, right? Because I think markets here in India and around the world are trying to figure out whether, they should be looking at the economic issues or threats imposed by tariffs or looking through them and marching higher. This morning is that march higher across most of the indices.
Well, Prashant, looking forward to the feedback you're going to get from that conference, because yesterday at the BofA conference as well, one thing was clear: you threw any kind of bad news to the Indian markets, that's being gobbled into. But first up, let's hear your conversation with Jonathan.
Well, absolutely, guys. So, as I said, I'm coming to you from the sidelines of the Morgan Stanley Annual India Investment Conference, and I'm sitting down with Jonathan Garner, who is the Chief Asia and Emerging Markets Equity Strategist, one of the top equity strategists, really, one of the top minds globally. Jonathan, it's a pleasure to have you with us here. Thank you very much.
Yeah, thank you.
Thank you for doing this, and I think it's an annual ritual, and we're very glad to have you. So, Jonathan, what's top of mind? What is going to be top of mind? Let me sort of preempt that a little bit as you start and kick off this conference over the next couple of days. What is the one question you expect to hear the most from investors?
Well, we're very bullish on India. It's our largest overweight. And if you just look at the most recent quarter, 7.4% GDP growth, I mean, that is far and away the strongest of the major economies in the world. So I'm looking forward to hearing at a granular level what the companies have to say about the growth environment and how investors react to it.
So right there, top of the pack, India, for you.
Absolutely.
It has been for a while, right?
Yeah, we've been overweight India really going all the way back to, I guess, the sort of the COVID era. And if you look at earnings growth for MSCI India, which is the investable universe for the global clients, earnings is compounding in dollars around 12% per annum now. We're in the fifth year, really, of compounding at that rate. And though there have been some cyclical bumps along the way, there was in the second half of last year, again, that's the strongest dollar earnings per share growth, really, of any major market.
Jonathan, it straight away comes to valuations, and I think you get a lot of questions around that as well. So there are about 550 companies in India with a market value of greater than $1 billion. 300 of those now trade at over 40 times trailing earnings. I mean, 40 times trailing earnings, as you said, earnings growth of about 12%. That's the average, of course. I mean, some would be higher, some would be lower. Are valuations a problem?
Yeah, so I don't know about the top 500. The MSCI India is trading on about 22 times forward PE, which is roughly the same as the multiple on the S&P. But actually, the earnings growth here is faster than the S&P. Not necessarily the Mag 7 companies, but it's faster than aggregate S&P earnings in recent years. Return on equity here is around 15-16%. It's somewhat higher in the US. But really, the reason I'm comparing it with the US is it's a growth market in terms of earnings growth, and so it should be on a growth multiple. The markets that we tend to disfavor in Asia and EM are what we might term value trap type situations, or situations where they've been priced very highly, but the earnings growth is not really coming forward, or it might be more cyclical than investors expect. And certainly on India, last time I was here in January, there was a big debate about the cyclical slowdown at that point. Indeed, amongst domestic investors as well as foreign investors, concerns that after last year's elections, we might be headed for a sustained growth slowdown. And that was not our view, that of our economists and local analysts. And it's really good to be back here in May and seeing that the economy is reaccelerating.
And we got the latest GDP numbers, which were better than expectations. And I mean, I think those tax cuts, etc., will also start to feed through, show up in some way in terms of increased consumption. RBI is embarking on a rate cutting cycle, hopefully this Friday.
Yes.
And we'll see many more to come. So all these add into that view, Jonathan, right?
Well, that's right. I would also add that 10-year bond yields are very well behaved and moving lower at a time when in many other geographies they're not doing that. And that's all testament to this virtuous circle. If you're growing strongly and attracting domestic capital formation and inward foreign investment, you can have a strong currency, reasonably strong currency, but also well-behaved bond yields. And I would also mention that the volatility on the Indian equity market is much reduced now, which again affects the risk premium as foreigners would see it. It's trading less than half the volatility, for example, of a major Asian index like the Hang Seng Index, when you look at, let's say, Sensex or the Nifty.
And that is a big part of the pull, I mean, the stability, the low volatility in that sense?
Yes, it's a structural overweight for us, India. And again, that valuation point, which investors, if you're a growth investor, you're reasonably comfortable with it. If you're a value investor, you tend to be frustrated because you want exposure to India, but you're not going to get to buy it cheaply in this environment.
Jonathan, you advise institutional investors and you say, well, you're overweight India. Well, I guess local investors have been overweight, double overweight, triple overweight India for the last many years. And they're such a big factor for the resilience, the outperformance, the stability, etc., that you've spoken about. Those systematic investment plans, right? Every month pulling in record amounts, higher and higher amounts.
Yes.
And that's been a big part of all of it.
Yes, absolutely. And it's a very attractive feature of an equity market if locals are committing regular pools of savings into that equity market. And it's not true of some other large EM. They don't have that characteristic. In fact, there's an academic literature about this, that if you have a young middle class that's investing in equities, it tends to go hand in hand with performance, but also, as we've already mentioned, with relatively high valuations. So when you had that kind of demographic tailwind in Japan in the 1980s, that was a positive. Similarly, in the 1990s in the US.
Okay. So foreigners are going to commit more and more capital here. I mean, because we had a bit of late September or so, foreigners started selling, and to the lows that we saw earlier this year, about almost $25 billion went out in terms of selling. Many point out it is because of global emerging markets seeing redemptions, etc. It's not so much about India. GEMs as an asset class was getting outflows. What's your prognosis from here?
Yes, I think for every buyer there has to be a seller by sort of definition. So if you have a strong domestic bid, that will pull some selling down at higher valuations. But I would point out that there's a lot of IPOs that happen in India, secondary issuance, and so the weight in the EM index is constantly rising. It's the second largest market in the index now. And so what we're seeing is like passive allocations are building towards India, but also for the first time, non-EM dedicated investors who tend to maybe have more of a growth style bias are starting to get involved in India, because it's no longer within the tracking era for a truly global equity manager. It's around about 2.5% of the All Country World Index, which means that those truly global investors have to buy their first or second India stock.
And that's starting to happen, because I've heard it for the last many years that global funds have very little exposure in India. The big global funds have little to no exposure, and you're saying that's starting to change.
I think the last sort of 18 to 24 months, it's starting to change, absolutely.
And that passive point as well, it is a recent phenomenon. I've heard that elsewhere as well, that a lot of passive money is starting to come in.
Well, you're right that there were passive outflows last year from emerging markets generally, but now that the cycle in the US dollar has turned and the US dollar itself is starting to be structurally weak, we're seeing this kind of interest in investing internationally, in Europe in particular, where there have been very large inflows, but to some extent in Asia as a whole, Asia Pacific, and India's getting some share of that.
Let's just look at the other stuff, the big calls. I think your call is dollar will fall. The broader dollar will fall substantially. Is that the view?
Yes, we think on the DXY index, the broad trade weighted dollar index, it'll get down to around 90 over the forecast horizon. So that is a good sort of 9-10% decline from current levels.
And what's going to be the dominant driver for the fall there for the dollar?
I think it's a couple of things. The most important is narrowing of growth differentials in our forecasts versus the rest of the world. As I mentioned, we have India growing easily 6.5% or so. US growth is going to fall, we think, next year to around about 0.5. And at some point next year, not this year, next year, the Federal Reserve will cut interest rates. So we have a sort of a decline in growth differentials. We don't, for example, have European growth changing very much over the forecast horizon. But then also I think there is this issue that's appearing where for 15 years we've had very large foreign investor portfolio flows into the United States. And it's driven some of the outperformance that we've seen in US markets. And I think investors are now looking at the world. They're looking at their kind of political risk exposure more generally. They're looking at many different factors that affect portfolio decisions. And they're choosing to reduce somewhat their structural overweight on the US. Now, again, we have somewhat of a nuanced view here because for the US equity market itself, we do think that weakening dollar can actually help the earnings profile of US multinationals. Some of the mega cap tech names have very strong revenues internationally, so they can actually benefit there. So there's a kind of an interesting interplay there. We actually think that the S&P 500, for example, can get to 6,500. And that's a decent return in dollars. But for a global investor, you have to factor in the likelihood that the US dollar itself weakens. So if you're based in the Eurozone or you're based in Japan or Australia, you have to factor in that dollar weakening.
But growth in the US will not slow down substantially so as to hurt growth elsewhere as well. And then, I mean, some of the other assumptions don't come into a question.
It depends who you are. Obviously, there's the tariff and non-tariff issues that are going on at the moment. But if you...
Sorry, please go on.
It's not my phone. But actually, if you look at the situation in Asia, we've got GDP growth in our forecasts slowing in the more trade-dependent economies of Asia, for example, Taiwan or Korea. But for India, it's not that dependent on manufactured trade relations with the United States. It has a big services trade relationship with the United States, but that's not necessarily in scope for what's going on here. But it has very strong domestic demand drivers in terms of the urbanizing population, the formation of the middle class. And so actually, of all the geographies in Asia, it's the one that should most decouple from this decelerating growth path we have for the United States.
Got that. Let us talk a little bit about sectors here in India. Financials, I think, has been a big overweight for you for a while.
Yes, we like financials really across Asia, but particularly in India, because they're a sector that actually generates revenue growth directly from underlying domestic economic growth. And that's what we're seeing. And they can probably grow earnings somewhat faster than overall nominal GDP growth. So maybe trending faster than that overall 12% EPS growth that I mentioned earlier. But we also like in India industrials and consumer discretionary. So we've got a full sort of set there of domestic exposure. Where we're more cautious is on some of the, let's say, defensive sectors like staples or some of the sectors that actually trade in goods and services that cross borders, where the actual revenue streams that they get in US dollars, when you translate them back into Indian rupee, are maybe going to be less attractive because of the dollar weakening trend.
So financials, industrials, consumer discretionary.
Yes.
These are the big ideas. Within industrials, I mean, which sub-segments, segments?
Well, I was actually just reading, arriving here, reading the local press and catching up on what's going on in cement and on CapEx. Again, that was quite weak back end of last year. But those areas where our analysts have been upgrading some of the names, they look inherently interesting to us. So, both a government and private CapEx cycle. And all that feeds into that.
And consumer discretionary? I mean, any particular areas, really?
Well, I guess we're waiting to see around truly significant local brands. That's something that I covered a lot in China through its economic development as we develop local brands. That can be extremely powerful. The traditional areas to get exposure to are autos and two-wheelers, but the auto sector is relatively problematic at a global level, particularly around some of these supply chain interruptions in the EV sector and in price competition. So one needs to be a little selective, but unfortunately I can't go into the individual stocks.
With regards to what the central bank here will do and what the fiscal response really is going to be, I mean, you think, any forecasts really in that sense?
Well, we think 2 rate cuts, one likely this week and one in the second half of the year. And again, that's remarkable at a time when the Federal Reserve is not able to cut interest rates because of the initial stagflationary impact of the tariff and trade issues. So it is exciting to see lower short-term and long-term rates in India. That's very supportive of equities.
You know, just sort of pull back a little bit since we've talked about the micros. You said for investors, a lot of political risk exposure, etc., all that also has started to matter a lot more. And there is a lot happening. So what are the one or two big themes which come up in conversations with big global clients? And, you know, in the context of India, we always hear it's actually better placed than most in that sense. I mean, it's not really, there is this strategic competition between the US and China. Here in India, we kind of sort of, you know, we've been working with pretty much everyone in that sense. What is your sense, Jonathan?
Well, we're certainly in an era of hegemonic rivalry between the US and China, and our overall framework is what we call multipolar world dynamics, which we first wrote a Morgan Stanley blue paper on as long ago as 2018. So we've been talking about this for quite some time. And we did identify in that original blue paper India as particularly advantaged just simply because of its size and its history and its ability to forge relationships in this complex world with the other large powers. Now, that isn't always without tensions, and there are certain issues that can arise, particularly, let's say, vis-à-vis Russia, for instance. But those can be negotiated or dealt with as India deals with its relationship, particularly with the US and China, and that's what we're actually seeing. Whereas for some other geographies, some smaller geographies, they have basically been forced more or less by these developments to move decisively into one camp or the other, which reduces their optionality. So we would still emphasize, and did in our original work, that India is quite advantaged in this regard.
And it's played out like that, essentially.
Yes.
Since then, back in 2018 and what you've seen so far.
Yes, it has. I mean, one of the ways that you can sort of see that is that if you look at, say, FDI flows or private equity flows into India, they are very, very buoyant, and they come from, across the planet. They're not just coming from the United States. So I think this perception that we have is actually shared by many investors as they commit long-term capital.
And what is the sense about this shift away from, especially on the manufacturing FDI side, global MNCs setting up shop, factories building here in India? What is your feedback on that? Is that process underway? Because some say during Trump 1.0, countries, smaller countries like Vietnam, Cambodia, etc., benefited. A lot of the shift did not happen towards India. Maybe it'll happen this time. At least that's the hope. What are you picking up?
Well, if you look at the supply chain in smartphones or other areas of technology, it's certainly moved at some pace towards India. You're right that if you look at Vietnam in particular, it's had significant success. But India has probably outperformed some other geographies that have relatively low wages, for example, Indonesia, in attracting inward FDI. And certainly it's proceeding at some considerable pace.
Fair enough. And this shift will continue to happen over the coming, and that's the bet that many are making here.
Yes, and I think one thing that's important is, having seen this shift earlier in my career in relation to inward investment in China, which continually surprised on the upside, the reason that this is happening is not just for export, let's say, back to the US or Europe. It's to actually service the local market. And the local market, if your GDP, when we started this interview, is growing at 7.4%, that is highly attractive. So you have to have plant here at scale to service the urbanizing middle class, just as you did in China 20 or 25 years ago.
So it's not just a factory to the world, but it's essentially the large local market as well, which is the attractive.
Yes, and by setting up locally, if you're an inward FDI multinational, you'll inevitably get to learn more about local market, local tastes, and what the consumer wants, or how you can actually develop your supply chain, and all of those sorts of things that was going on in the southern part of China or around Shanghai in the past.
A slightly near-term question. India was said to be one of the first in line to get a deal with the US. I think various officials, including President Trump, have spoken about it. Not got there yet. You think it's going to take time? It's delayed for some... what's your reading of the situation?
Funnily enough, as I was just getting up and having breakfast this morning, Commerce Secretary Howard Lutnick was actually talking about the deal with India being relatively imminent.
Yes.
And we would still anticipate that India would be one of the first countries where there will be at least an outline deal done.
And an actual one, of course, takes a lot longer, a proper deal.
Well, if you look at
an agreement and then, of course, a deal later.
Yes, if you look at the United Kingdom, which has done an outline deal, that's sort of what we're talking about here.
Do you have an assessment of where tariffs in the US, by the end of all of this sort of, upheaval, up and down and pull, back and forth, is going to settle at? When President Trump came in, I think average tariffs are about 2.5%
Yes.
to 3%. They're significantly north of 10% now. Where do you think we will be by the end of this year, according to you?
Well, not lower than 10%. I mean, this is part of industrial policy in the United States, and it also raises tax revenue. So it has those two planks that underpin the philosophy here. We think for most countries, it's going to be sort of lower than where we obviously got at the peak of the post, like, Independence Day announcements. But for China, it'll probably be materially higher than for the average country. So this hegemonic rivalry between the US and China will result in higher tariffs that both will have on each other by the end of the year. Whereas for India, we would expect it to be relatively low.
But average, at least 10%.
I would say at least 10%, not back to
China,
the number
I mean,
of 2
north
or
of 30%, or
we have it at the moment running around about on a weighted basis across all the product lines. It's about 45%. It might end up somewhat lower than that, but maybe not materially lower than that.
What are the big risks, Jonathan, that you think about, which can sort of which can derail some of this?
Ultimately, we're investing in a multipolar world environment, which is inherently complex and risky, as we see. But again, I want to emphasize that point about volatility. I mean, we've had exceptional volatility again in markets this year. But India is not at the heart of all of this. India can get on with its own business and do very well economically and as a market.
I got that. Russia, Ukraine, for example, any thoughts on this recent escalation?
I can't comment on that.
Okay, fair enough. I mean, I think we've seen some developments over the weekend, but things to watch. It's a war which has gone on for 3 years with little impact, probably from a market standpoint. But we will maybe pick up on this later. Jonathan, we'll leave it there. Great conversation as always.
Thank you.
Thank you very much for doing this. Really appreciate it.
Yeah, great to be here in India. Thanks for having me.
Good luck with the conference.
Thank you.
What we're going to do